So it's interesting to look at the experts and see what they predicted. They all revised their predictions pretty much upward because the real estate market has surprised them. And it's done a lot better than they thought it would. In fact, we have literally year-over-year appreciation after tripling the cost of money. It's insane. So the experts have all been wrong, okay? I know I'm wearing out this chart. I've shared it a lot, but it's so important. Context and content. Most people are talking about what happens now if someone buys a home today and what they're facing versus what's really important, which is all of the people, the millions and millions of people who bought or refinanced a home during the COVID era. That's more important than what someone experiences today, and I'm going to tell you why. 25% of the mortgages in the country, approximately, are at or below 3%. 65% of the mortgages in the country are at or below 4%. These people have very affordable homes. And guess what? Not surprisingly, they're not selling. Now, everybody freaks out when the interest rates go up. When the mortgage rates go up, everybody's so worried. They're like, oh my God, the market's going to crash. It's got to crash. The rates are so high. There are 140 million housing units in the United States. And the vast majority of them have very cheap, affordable mortgages. And actually, 40% of them have no mortgage at all. As everybody's talking about a crash, these people are sitting here saying, my deal is so good, I'm never going to give it up. So that's the lock-in effect. It's like working for a big corporate employer and having the golden handcuffs, right? You stay there at that job because what they've dangled into the future with your retirement plan, et cetera, is so good that you're just not going to give it up. And that's exactly what they're experiencing. So the higher interest rates go up, the more valuable the existing mortgages in the market are to all the people that have them. The mortgage is the asset. Think about it that way, okay? All right, inventory, real quickly. There's just over 500,000 homes on the market in the US. This number is going up. Inventory is definitely increasing. At the lowest point during the COVID era, we had 240,000 homes for sale in the country. So inventory is increasing, but compared to what? So if you compare it to, 8 years ago or any one of several years in the last 8 years, we should have about 700,000 more homes for sale. So we have a huge inventory shortage still. But if you fall for the clickbait in the media, it'll say inventory is skyrocketing. Okay. Compared to what? Yes, that's true, but it's not that bad yet, okay? So we need to be at this much higher level. About 1.2 million is about the normal market, which gives us, give or take 6 months of supply. Nobody's selling their home. Fannie Mae doesn't have any foreclosures to sell. Sorry, folks, okay? One ingredient you must have if you want to have a housing crash is millions of distressed sellers. You just don't have that. If you're in the foreclosure business, there's hardly anything going on, okay? Mortgage delinquency is below, or it falls to the lowest level since 1979. So how many homes are underwater? Well, let's ask the question, compared to what? Right now, 2% of the homes in the country are underwater. In other words, they have negative equity. In 2008, 26% were underwater. This is different. Now, you might be thinking, why did I put the turtle on there? That cute turtle, what's it have to do with it? Okay, we'll go to this one instead. It's a better looking slide. Okay, 26%, we don't have that. We would have to see a massive increase in underwater homes for people to be in distress. They're just not there yet. Now, this is the mortgage debt in comparison to disposable income. And you can see since the early 80s, it's almost the lowest it's ever been. Let me blow that up for you. It got a little lower during the COVID era, but it's still very affordable. These houses are for people. And you know what? It's interesting that one of my fellow speakers this morning was talking about Back to the Future, Dolph, right? And this was already in my presentation. So what we're going to do here is time travel for a minute. So let's time travel. Let's assume we bought or refinanced a home during the COVID era. And the median mortgage payment then was just over $1,000. The house was about $400,000. And that was like traveling back in time 10 years because you got the same payment, approximately, on a $225,000 house back then. But what does that really mean? That means the people that bought or refinanced during the COVID era have the same deal all the people got 10 years earlier. Pretty good, huh? Right? Say pretty good. Yeah, it's pretty good. But wait, there's more. It gets better. Since then, we've had 26.7% of something. What might I be talking about? Inflation. Cumulatively, we've had 27% inflation. Officially, now the official numbers underestimate inflation massively, but let's just go with the official numbers for a second. So let's look at our chart again. We have to revise it to see the reality, to see the truth in this chart. Because the truth is that in that 10-year time period, yes, we might be writing the same check every month, and tens of millions of other people are writing the same check for their mortgage every month, but the real value of that check is only $730 a month, adjusted for the dollars 10 years earlier. In other words, in constant dollars or real dollars. That's the way an economist talks about it. What does it really feel like? How much money do you feel like you're giving up every month, right? $730. That's the mortgage payment most people in the country really have, okay? And if you adjust the price of the house, it was $225,000 back then. Now it's $290,000. So the price of the house is a little more expensive for sure, but again, it's not $397 like most people think by looking at the sticker price on the house. So we've got to have those comparisons. We've got to use inflation-induced debt destruction, which is this phenomenal strategy.